Let's talk about the different forms of hedge fund investments. Of course, LPGP is the main one, right? You have your general partner who manages the fund, you have your limited partners who invest in the fund. So that is something you already know. You have something called the fund of one. So here, the difference between LPGP and fund of one is that there's basically just one investor, right? So you're making the fund just for that one investor. Then what you have is something called a separately managed account. And the difference between fund of one and a separately managed account is, even though in both situations you still have just one investor, but the custody of the assets is with the fund, right? And in the separately managed account, the custody is in the individual's account. So it is with the investor. And the fund manager only takes the buying and selling decisions in the case of an SMA. In the case of a fund of one, the fund manager takes the buying and selling decisions, but also has the custody of the funds. And then you have something called a fund of funds, right? Where this is for very, very unsophisticated investors, those who can't withstand the lock-in periods. So they'll invest in a fund of fund, and then this fund of fund invests in a lot of different hedge funds, right? And if this investor wants their money back, they'll just take it from one of the funds which has the lock-in period is over, and they can easily take out funds and give to them. So this is a way where normal retail investors, so I would say retail investors, can get access to this hedge fund space, right, through a fund of funds. But then what happens is there's a double layer of fees. So here the fund will charge 220, and then the fund of funds will probably charge 110, so they get charged fees twice. But this is the best option they have, because they can't really go and directly invest in one of these funds, because number one, they wouldn't know which one to invest in because they don't have that due diligence expertise. And number two, even if they chose one, there's going to be lock-in periods and all sorts of complicated clauses that they'll have to deal with, and maybe there's going to be a minimum investment size. So that's why you have these fund of funds. So these are all the different forms. Let's get into all of them. Of course, LPGP, very straightforward. You already know all about it. What you need to also know is that this is referred to as the direct form of hedge fund setup. And for those of you who don't know what an LPGP is, the GP is the general partner. This is the fund manager. The investors are the limited partner, right? These are the investors. And why the word limited? Because their liability is limited. And the way it would work is there'll be a fund. This is where they would put their money. The GP would manage the fund, and the fund would make the investments. Now, if something horribly went wrong in the investments, right, the GP has unlimited liability. The LPs have limited liability. So maximum they can lose is their investment, right? Usually what you have is a 2-10-20, which means 2% management fees, 20% incentive fees. But now what's happening is that investors are pushing for something which is 1 or 30. It's not and, this is or. So either you get 1% management fees, or if the fund is doing well, you get 30% incentive, which is a percentage of the profit, and no management fees. And even that 30% in some cases is not on the entire profit. So let's say you started with the 100, you ended up with, let's say, 200. You ended up with, let's say, 200. So they'll have a certain prerequisite that the first 20%, no profit is going to be paid to you. So you'll only get 30% of this additional amount, which is from 120 to 200, which is going to be 80, right? So you'll only get your fees on that. And where is this 20% coming from? It could be a absolute benchmark. It could be a relative benchmark where we could say whatever is the S&P 500 return, and you need to beat that, and whatever you get more than that, then we can give you 30% of that. So this is what's happening in the LPGP space. A very interesting thing is side letter. So what happens is some LP wants special terms, right? So these are your normal LPs with which you will have your limited partnership agreement. And then you have a special LP coming in who is saying, I'm going to do a very big investment, right? And I'm not going to ask for the money back for the next 10 years, something like this, right? So they're accepting less liquidity. They're making a big investment. So what we can have with them is something called a side letter, right? And that will list all the terms that we will agree to them. You could also have a SMA, separately managed account, or a fund of one. So this is basically both of them are for one client. That your one client is so big that you don't need any other clients. But the only difference between these two is if the client wants custody in their own account, then you'll do an SMA. If you are making a fund for them and the money is coming into the funds account, then it's going to be called a fund of one. Right, SMA will be registered under the investor's name, and the manager only is going to take the day-to-day buying and selling decisions. Yeah, that's what it is. And if the investor is big enough, then SMA could be very, very good structure because you can exercise greater control. The investor can exercise greater control and can keep a check and balance on the fees as well. Right, so this is of course an ideal situation where you keep the assets in your name as an investor and the fund manager helps you manage them, but then you need to be big enough to be able to do that. Right, now coming to the fund of funds, right, a fund of hedge funds, which is basically the fund of funds. And why do we need this? Because, well, some individuals, they don't know which hedge fund to invest in. They don't have the due diligence expertise, right? Maybe they don't have the minimum threshold required for investment. It's like $1 million at least. So that's why they can invest in the fund of funds, right? But even though they're getting benefits here, right? They get to benefit from the expertise of the fund manager. The problem could be that double layer of fees, right? So yes, there are benefits. You get better redemption terms. Probably don't have to wait for that lock-in period. You get the due diligence expertise. You get the diversification benefit across so many different hedge funds. But please keep in mind, you'll have to pay 2 layers of fees. First, each hedge fund will charge their fees, and then the fund of funds is going to charge another layer of fees. Right. So let's take a break. We'll come back and we'll